So today you make sure that you are making the groups. And what is the procedure to make the groups? It's given here in the course description document. This is your most important document where all the rules, regulations, contents, evaluation, assessment, everything is mentioned in the fullest form. So you please go through it. And discussion forum, of course, you will be, you should be following, and you don't have to wait for my messages. If you have something to ask me or your friends, you can start a new message very easily. It's quite simple. Just start a new message from here, for example, add new topic, and that's it. And then the study material, very quickly, I want to share with you that you have the lecture slides, your main source of information. The first point of content or contact would be the lecture slides. And because you will be doing 10 tasks, and those 10 tasks are based on the application of the theory in the real life scenario. For each task which you'll be doing, I have added the templates here. You know templates? The examples, so that you know how to do the task. Are you with me? So I don't want you to struggle. I want that when you want to do task 3, you see the example of task 3 here, the way I calculate, and then you know, oh, this is what SHAP expects from us. And then you do for your company or companies. Yeah, sound good? Then there are some research articles which I have added already, but I would be keep it updating from time to time. Your videos would be recorded, like right now. I'm making a recording, and once this recording is over, I would be sharing. I would convert the video to YouTube, yeah, and then the YouTube link will come here. Okay, and then I have added some textbooks for you. These are, in my opinion, these 2 books are the best books. When you are a beginner, when you are the either beginner level or in the intermediate level in the field of finance, then especially in the corporate finance or in the investment management, then these 2 books are the fabulous books. And these are here available for you. You don't have to look. If you want to search for more books, it's good. But these, the bare minimum, the basic books are here for you. So make use of them. So the lecture slides, I start topic 1, fundamental issues today. But I will open from my folder. I feel more comfortable with that. Fundamental issues. Right. Students following online, can you see, are you able to see my screen, the slides? Can you see it?
Yeah, we do.
Can you?
Yes.
Okay, good, good, good. So I start fundamental issues today. And if you remember, I shared some videos also. Did I share any YouTube video last week about risk and return, the basics of risk and return? That will be very useful for you, even though I'm making a recording of this meeting as well. So you can have multiple meetings, yeah? We were talking about the rational word. I think we were stuck on only one slide last time, and we were wondering what this rational means. So we will be behaving as rationally as possible as a potential fund manager in this course. I often say that students who do this course, I don't consider them as students. I consider that they are working for some hedge fund, and I'm their coach, not teacher, but they are the trainee. So you are my trainees. And after this course, I assume that you'll be working in the real life situation. So I want to make it as practical as possible, but if you are too practical, then the danger is that you can lose common sense. I'm sorry for my harsh words. And the common sense comes from theory. That is why we will be taking theory along at every step. But we will not study any abstract theory. We'll be only studying those theories which you can apply straight away, right? So, yeah. The hurdle rate, let me shut the door. Nobody comes down.
Shab, you need to
Hello.
share the, it's not
Can you-
sharing the,
Sorry?
it's not
Arthur?
sharing the, it's not sharing the PowerPoint.
Oh, you can't see it?
No,
Okay,
it's
wait a
in
sec.
No,
Sorry
we
about it.
just see Optima.
Yeah, I'll do it straight away.
Yeah, it's fine.
How about now?
Functioning,
Can you see
thank-
it?
Yes, functioning, thank you.
Good, good. Okay. So the hurdle rate we discussed last week, that have you seen the hurdle race, the 110 meters hurdle race, 400 meters hurdle race? What is that? What happens there? Have you seen a hurdle race? Yeah? Haven't you? So there is a track, and then there are some bars, and you have to run and jump at the same time. When do you fail in that race? If your foot touches the bar, you get injured, definitely you will not be able to win. Though it doesn't matter you cross the hurdle by 1 inch or by 1 centimeter or by 1 millimeter. As long as you are able to jump over the hurdle, you are in the race. Are you with me? Same way in finance. We have a hurdle rate. We have to jump over this hurdle. You jump by this margin or you jump by this margin. It's fine. Yeah? Have you even seen hurdle race? Tell me. Have you or have you not? You haven't? Okay, let's watch YouTube. Guys, it's very important that I show my students some YouTube video. Let me share this video as well. Let me share the screen as well, because it's very important that we know some athletics before we study finance. There we are. So what did you notice in this hurdle race? Did you see anybody dropping the hurdle, hitting it? They were. Right at the beginning, there were 2 athletes who hit the hurdle. Definitely they didn't win. And then somebody in the middle of the race also hit and went out. And I saw one guy, maybe you noticed or not, he was a little bit uncomfortable when he touched, because it really hurts. It really hurts when you touch, especially when you're running at such a speed. it really hurts. And we have a very famous athlete here in Finland, in Jyväskylä, Lotta. Have you heard about Lotta Nazari? I think she's a fantastic athlete, and she runs the hurdle race as well. So the point I'm trying to make here is that the hurdle race, the hurdle rate, not race, the hurdle rate is something which you must achieve so that you are able to fulfill the aspirations of your investors. Remember, you are my trainee investors, okay? The hedge, the fund managers, and I want you to produce the return which is over the hurdle rate. It can be much more over, it could be a bit over, but it should never be just equal to or below the hurdle rate. If it is equal to the hurdle rate, you will touch the bar. And if you touch below the hurdle, then you will hurt your knee also. It means your investors would be very angry with you. And of course, I'll be very angry as well. So in that case, you need to jump over this hurdle rate. The question is, how does this hurdle, or where does this hurdle rate come from? Well, it comes from two components, and these components you can see here on the in the slide is that the hurdle rate is equal to risk-less or risk-free rate of return plus the risk premium. And when you combine them, it becomes the minimum hurdle rate which you must generate on behalf of your investors. And if you can't generate it, keep your head high, don't feel ashamed, give the money back to them and say, hey, we are out of business. We're no longer in the game. Go to somebody else who can do this on your behalf. And if you don't do it, then you lose market reputation and people will, the investors, you will lose the clients. The hurdle rate has two components, the riskless rate. The riskless rate is something which has no risk. Now this sounds very bizarre because what is in the life without risk? Life is full of risk. You have left your countries and you came to Finland to do exchange studies. Is it riskless? It's not. You lose, huh?
If you don't have a plan, it's risk.
Yeah, but there's always a risk of new place. When you move to a new place, it's always risky. You take a chance, you stay away from your friends, you may feel nostalgic. There are many things which you can feel not so comfortable about. So it's not just as such that you move from one place to another place and you behave as if you behave in your home. So many changes. Okay, it takes a few days before you know which is the right place to do the grocery from, or which is the right bus, or if you have to go by walking, what is the best way to walk? What is the shortcut to go to your place of work or study? In finance, the riskless rate comes from those securities which are issued by the state. And these are called T-bills or T-bonds. T stands for the word treasury. Treasury is that component of the state which deals with the state's finances, which deals with that where cash comes to the state, where the cash goes to, at what rate the state borrows. So all these things about borrowing, lending, cost of borrowing, cost of return on lending, when the country will get money for its exports, when the import payment is due, Okay, for example, in Finland, the rule of the treasury can be that when will money come from the export from the USA? So Finland sells something to US, the money will come in 6 months, okay? But in 5 months time, Finland has to make a payment to UAE for its oil imports. So how this balance will be made? So this balancing of money coming in and money going out is the job of the state treasury. Often this is done by a wing of the central bank of the country, okay? The rate at which the state borrows from you is called riskless rate. Riskless rate basically means that there's no risk. Remember, in finance, there is no absolute divine truth. Finance truths are based on probability. Riskless means no risk. Risk of what? Getting bankrupt. States don't get bankrupt so often. Even though there have been states which have been potentially bankrupt. If you look in the net, you will see many countries, if IMF, World Bank, or this European Union, if had they not been helping that country, the country would have become bankrupt by now. It means even the countries can become potentially bankrupt, if not in reality, but potentially even the states can get bankrupt. But what is the probability of a state getting bankrupt? Huh? Yeah, but what is the probability? How many states have you seen got bankrupt in the last 20 years? Huh? No, yeah, but they were not declared bankrupt. Huh? It's not same as the default. Yeah, I mean, when you make a default, my question is, maybe I'm not able to convey my question. How many states have been declared bankrupt? When UNO make a decision that, you know what, this country has become bankrupt, can somebody buy it? Zero. But has it happened in the companies, the private companies, which are declared bankrupt, and then somebody acquires them? AOL acquired Time Warner. Mercedes-Benz is an example when one company acquires other. Okay, and we know all about this Google and Yahoo and all that stuff, Microsoft. So a company ceases to be a company. But there's no example, to my opinion, in my mind, where the state has ceased to exist because it has become bankrupt. Even though the example which you quoted, Venezuela, Mexico, Argentina, couple of countries in Europe, like Italy, Greece was an example. Ireland has very tough time. The whole Southern Europe saw a very difficult time not a long time ago. Portugal. So, or if you want to see the very close to bankruptcy, Zimbabwe in Africa, where the inflation rate was about 1,000% a day, right? So, but the question is that we believe in the probabilities in finance. The probability a state getting bankrupt is very, very low. Okay, then the question is, where does risk premium come from? Are you okay with this word, riskless or risk-free? Normally, I use as R subscript F as a symbol for risk-free rate. The risk premium is, imagine the state of a country, I mean the state of Finland, let's say. Their representative comes here and you guys got money. And this representative is asking that, hey, the Finnish states want to borrow from you. And then I come suddenly and I also say that, hey, I also want to borrow from you. So there are two people asking you to give money, right? And you both agree. Half of you agree to give money to the state of Finland and half of you agree to give the money to me. Who would you charge more interest? Why? Because I'm risky. The state is not risky. The private entity is risky. There is always a risk that the company can default. The company can run away. The company can disappear. But as we discussed a few minutes ago, the states normally do not disappear, even though they had very tough financial crisis. I always give the example of Enron. I hope you know that Enron was a company, American company, which got bankrupt in 2001. It was the fourth most successful company in the Forbes list. At that time, when it became bankrupt, it disappeared in 2 weeks' time. Suddenly it disappeared because of its corruption and those bad corporate governance of the company. But the point I'm trying to make here is that the companies always carry a risk of default. If Enron was a country, it would have been saved. And if Greece was a company, it would have disappeared. So therefore, if the two people asking you to deposit money, you will be ready to only demand risk-free rate from the state, but you will be demanding something extra from me. And this extra you are demanding from me is called risk premium. And let's say you are demanding 2% as risk-free rate. From me, you are demanding 3%. What happens then? 5%. It means that the investment, which the investment which I do, and you give me the money, my hurdle rate is 5%. I must generate 5% to satisfy my clients. My clients means my investors. And if you find somebody coming who is riskier than me, and then this risk premium can go to 4% or 5%, 7%. And if somebody who is lesser riskier than me comes, so the hurdle keeps changing. And it not only changes for a person or for a company, it can change for the same company in different times. At one stage, you were a very less risky company. The risk premium attached on you was only 2%. But next time, your risk level increases and it becomes 3%. Because the companies, now you see in the COVID-19, in the post, or in the, it's not post, unfortunately yet. I wish it get post soon. The pre-COVID and the during COVID, look at the risk premium of the company. It has skyrocketed tremendously, went up like a spike. So it shows that even for the same company in different times, the risk premium demanded by the investors could change. So in a given time, the risk premium will vary from company to company. And over a time, for the same company, risk premium would change as well. So the risk premium is a very dynamic concept. Then I raise some questions for introspection. And the question is, why does risk premium differ from firm to firm? And the second question is, why does even low firm risk has a higher hurdle rate than risk-less rate? But let's first try to find the answer to the first question, that why does risk premium differ from firm to firm. To understand it, to know the answer, we need to go to the basics of risk-less rate. Now, I forgot to mention that when I say risk-less rate is on the securities issued by the state, which is called treasury. These are treasury bills or treasury bonds. If I'm the state representative and I ask you to deposit money with me, I will issue you a piece of paper. I give it to you, and then you give the money to me. And when the loan period is over, I get the paper back from you. I give the principal amount plus interest to you. Sound sensible? But the question is, what is the difference between bills and bonds? Bills are issued for the short period and bonds are issued for the long period. Question is, what is short and what is long? Yeah, so the short period is up to 364 days. In finance, the short period is up to 364 days. So if somebody is borrowing from you, let's say the state treasury is borrowing from you for 364 days, then it's a bill, treasury bill. But if it is 365 days or more, if it is 365 days or more, it is called long period. And then it becomes a bond. So bills become bond. Bills and bond depend upon the period of maturity, when the loan would mature. If the loan matures in under within 364 days, then this is a bill. If it is 365 days and above, it becomes the bond because it is for the long period. This is a definition. You can see something on the table. I gave the example. There is an article which I have shared with you in Optima. It's here, not actually here. I can quickly stop share for a second. And I share the new thingy. There's an article which I have shared in Optima. And the article is here, I guess. We are research articles. And the article's name is, the first article, Triumph of the Optimists. This is a very easy article. I mean, you will not find any problem, I'm sure. But at the same time, it gives very important information. And I copied this slide from this Triumph of Optimist article, which I want to show you here. So this slide, or this table which I have, is taken from the Triumph of Optimist article. Now, what does it say? It says that if you have invested in 1900, if your not father, but not grandfather, but even great-great-grandfather has invested $1 in 1900, how much it would have been by 2001. And you can see that in 100 years of 20th century, if you have deposited, if you have invested in the T-bill, you know T-bill? The treasury bill. Treasury bill is for how many years? Under 1 year. Then how come it's 101 years then? So you invest for 1 year, again reinvest, and this is called rolling period investment. So you roll over investment each year. How many years? 101 years. Then you would have earned 4% every year. 4% every year. And if you had invested in the treasury bond, which is the government bonds basically, and what is a bond? Yes, the loan which matures for 365 days and above. Then you would have earned 5.5% a year. And if you had invested in the shares in the equity market, you would have earned 11.1% a year. Now, when you see these three rates, what type of conclusions you make? Huh? Say again?
The government bonds our treasury bills as low risk compared to common stocks.
Yeah.
So with common stocks, we will have higher rates. With the government bonds or treasury bills, there is a risk to lose money.
Yeah, yeah, yes. I will not compare too much between treasury bills and the government bonds, but I will be interested in the securities issued by the private sector and by the government sector. The first two securities are issued by the state, whether for the short period or long period, they belong to the state. Okay, but look at the third option, common stocks, the private companies. Look at the rate of return, 11%. Why so? Because they have more risk attached as well. So there's a saying in English, no pains, no gains. So the gains come from the pains. If there's unless you have a pain, you will never gain. So there is a cost of getting success. Because in the government securities, both bills and bonds, the pain of losing money is less. Therefore, the return is also less. If you ever get a chance to go to the website of your the central bank of the country you come from, Italy, France, Finland, you will see that the bills and the bond rate issued by the state is not very huge. It's very minimum. These days, I mean, maybe there's a little bit increase, but some 3-4 years ago, it was almost negative. 0% negative, very low. But if you look at the equity market, it's always, comparatively high overall, the market, the index rate. So that shows that there is a risk premium attached to it. Now see, imagine one of you, now because we have three rates and we have three rows of people. If you are a financial analyst, the first column of students, and you are only experts in investing in T-bills, yeah? And the second row, the middle one, maybe I can combine you, is the hedge funds managers, the fund managers, whose only specialty is to manage the government bonds. And the last row belongs to those student trainees who are experts in the equity market. Look at the hurdle rate. For you guys, the hurdle rate is 4%. For the other people, based on the history, because the history, the thing is that we learn things from history. And there's a saying that history repeats itself, even though we never learn from it. So history is a mirror to the future. Today, what you do, if I asked you to do something now and you say, Shab, we haven't done this thing before. It's the first time, it's the first experience. Then I see, look at what people have done in the past. See them. So you are getting a reference from the history. And what you do today will determine your future, isn't it? You do good things, bad things today, that will come back at the karma for the future. So there is a linkage in the finance, like in life, between the past, present, and the future. Okay, so when I ask you guys, that, hey, what is your hurdle rate? How much you think you'll be producing for your investors? Sham, 11%. Goodness gracious me, why so? Because the history has been showing that equity market has always been risky. So we are living in more pressure situation. You guys are comparatively less in pressure, right? Because you come from safer, secure type of investments, but those people are taken care of. So that is why the financial market is quite stressful, situation. Like, but anyways, not my objective, because it is more to do with economics than finance. Can you see here two rates, nominal and real? Just I saw them, so I'm interested in discussing about them, even though they're not really, they're more to do with economics than finance. Nominal rate and the real rate.
The real rate is about the real money that you have from this rate, because it counts the inflation rate.
Fabulous, fabulous. The real return is, the nominal return is 4%. The real return is 1%, about 1%. Why so? Because the real interest is the inflation adjusted, as you said. Fantastic definition you gave, is the reality. If I'm your employer, yeah, I give you salary increase by 2%, but in the country, in the whole country, the inflation rate is 5%. Are you richer than before? Yes or no? You are rather poorer. Your wallet has become bigger, but the value of money has gone down. So in fact, 2% increase in your salary, 5% increase in inflation, you are poorer by 3% actually. The same way, if you are getting 4% rate of interest on the paper, but actually that rate is 1.1%, it means that 2.9%, is it 2.9? Yeah, 2.9% is taken away by inflation. It means in the last century, in the USA, for 101 years, the average rate of inflation has been 2.9%, about a little bit, yeah. So it means that we always see the inflation adjusted rate of return. Otherwise, you can, we use a phrase in economics called wage illusion. Often the laborers, in a very socialistic type of scenario, the laborers are on strike. And what they demand? More wages. An employer is waiting, negotiating, the trade unions, all those red flags. It doesn't work. Eventually, the laborers get more wage. They're very happy. Oh, we won. Look, we have defeated the bourgeois. we are now more, victorious. And the owner, the employer is very clever. What he does, he pays them more wages, but he adds to the cost. And then what happened? Because the workers are also consumers. What happens when they go home? They have more wage, but now when they go to the grocery, when they buy cold drinks, when they buy food, when they travel, they pay more money. There we go. Wage illusion. Illusion means some kind of, yeah, you can be cheated basically. You don't know what is happening with you. So you are living in an illusionary world, not the real world. So the same thing can happen here. So that is why for many years in the past, people were not so keen in keeping their money in the bank accounts, because the bank was giving them 0.5% rate of interest. In Finland, approximately 0.5%, even less. And the inflation was about 1%. So people who were having big money in the bank account, they were actually losing money because it was not going anywhere. So this is the difference between the nominal and the real rate of return. So, yeah. And this is something based on, again, last 101 year risk premium on the countries. Because like two companies are not equally safe, two countries are also not equally riskless. Even though, now look, they all are countries. Can you see that? Like all of them are countries. So the return on the securities issued by each of these countries will be called riskless. But the question is, who is less riskless, who is more riskless? And you can see that Denmark's riskless nominal rate has been about 4%. And the other extreme is Italy, where the nominal riskless has been about 10%. So, and in between different countries, and the average, you can see here, the average riskless rate has been, riskless means on the treasury 10-year bond. As a standard definition between bills and bond, the standard definition or the standard acceptance of the riskless security is the treasury bond for 10 years. And that has been about 6.25%. Risk premium, yeah. So it's not just the riskless rate, but the risk premium. Look, if there's a country, the safest country, yeah, then the risk premium would be 0. So if we have an imaginary safest country, and if you want to deposit in Denmark in the last century, then in Denmark, you demand extra 4%. The baseline is 0%. But if you want to, so this is risk premium, that this is on top of the base riskless rate. So anybody who wants to move from from Denmark to Italy would be demanding, what is the difference, 4% and 10%, would 6% extra. So if somebody has a deposit in some Danish state security, and that person wants to move to Italy in the last century, then that person, and again, the investment is from state securities to the state securities, then you'll be demanding 6% extra. So there's a premium on premium, basically, the difference between the two premiums. So it means that in the last centuries, the nominal risk premium has been quite a lot. And to be fair, this was the average. And if you look at the last century, the first half of the century was very bad because of World War I, World War II, Great Depression, which happened, and then there was a hyperinflation. So Europe has seen very difficult times in the first half of the century, 20th century. But then things became better eventually, 60s, 70s, and then it was quite good, I would say. So overall, that is why, if you see for the whole package, entire 100 years, so the average is quite not so good looking, but we have to be careful. But this is just an indicator about risk premium, yeah? Riskiness of the project depends upon several factors. I want to ask you, if you are an investor, potential investor, and you are going to make a decision to invest, not to invest or disinvest, invest, you are going to make an investment. Not to invest, you make a decision that no, I'm not going to invest at all. And the other one is that you disinvest, Disinvest means you have invested, you want to take the money back, or you want to divest. Divest means you want to move your investment from one investment to another investment. You got the idea? You want to invest, the money leaves your pockets and you invest in some project. Disinvest, you take money back. Divest, you want to move your investment from Microsoft to Apple, let's say. What factor would you consider?
The quality of the management.
Huh?
The quality of the management of the company.
So the first thing you see is the corporate governance of the company, that who are the people who are running the show, what is their track record. Fantastic. So you will be seeing the company's leadership. The first point which has emerged is that if you want to make an investment, the first thing you will be interested to see is about the corporate leadership or the corporate governance. So leadership / governance is the first thing. You need to know that who will be utilizing your money. Are they real people? Do they have any track record in the past? Or they are just newcomers? This is why the startups have big problem, because they have no history. So that is why the specialized bodies which are giving startup finance, because these people have great ideas, but they don't have any history. So if you ask a common, ordinary investor, they will not trust them. Hey, you're selling dreams, yeah? So there is some specialized funders, financiers, the hedge fund investors who are giving these kind, the startup financiers. Okay. Any other point apart from leadership? Yes, sir?
What is the project?
You want to say the nature of project. Can you say something more about the nature of project?
If the project is
Yeah.
The risk will be after, if Apple want to build a new computer, it's not another project.
Yeah, that's a good point. That the nature of project is this investment under your specialty area. You know Marks and Spencer? The Marks and Spencer. If Marks and Spencer makes an announcement that they want to start an airline company, it's risky. Because this is not a specialty area. Marks and Spencer is a very old company in Britain. But Marks and Spencer have a history of these consumer goods, the retail sector, basically. And suddenly they make an announcement that they want to open an airline company, or they want to make some petrochemical industry. I mean, this is not going to work. But it may work, but it will at least send ripples to the investors. So the nature of project is very important. Risky the project, higher is the hurdle rate. Safer is the project, lower is the hurdle rate. But remember, if the company is private, then the risk premium would be there always. Some risk premium would always be attached to it. Because even the safest company in the world cannot be equal to the safest country in the world. Look at the situation. When you are an investor, you have to take two things in mind, especially when you are investing in a foreign company. If somebody wants to invest in Finland, they have not only to consider the nature and riskiness of the project, but also they have to see the riskiness of Finland, how risky Finland is. If you come from comparatively riskier country to Finland, then the risk premium will go down, because Finland has a fantastic rating. I think it's, I don't think it's AAA, but definitely it's AAB or AA something. Yeah, I think it's AA, yeah. Not AAB, it's AA. But if you come from even a safer country than Finland, then you demand more risk premium. For example, if you come from Australia, for example, AAA to Finland, then you demand a bit more, risk premium. So so not only you are interested in the riskiness of the project, but you also considering the country risk premium. This is why if you want to learn good finance, you need to learn good macroeconomics as well. So if you have studied economics in the past, it's an edge to you to learn finance in a better way, because finance basically is an extension of economics. Historically, finance has been a part of economics. So economics knowledge really give you better logic than without it. One last point before I leave, because I have a meeting, and then Tuan, you do one thing, you discuss with them the Excel, but please make sure that first you form the groups. Yeah, and the groups should be formed today. And then each group leader should send me the message in the discussion forum. Maybe you can start the discussion and then they follow the same thread. Okay, yeah. So one last point before I leave.
Financial reports.
Financial?
Reports.
Could you say something more? What does it mean?
Like the debts, the liability.
Okay.
I don't remember the name in English. But
Solvent. You mean solvent?
yeah, like you have a list.
Balance sheet.
Yeah, balance sheet. Yeah.
Yeah. So the balance sheet is good. If I want to invest in your company, right? I will definitely check your, like a health check, like financial health check. And your financial health come from the balance sheet. And if your assets are much more than your liabilities, it means that you are a solvent company. Solvent means you'll exist, you'll be surviving. That's a good sign for me to invest. But if I see that over the time, your gap between assets and liability is going down, it means your degree of solvency is shrinking. I should be alarmed, I should be worried. And if I'm already your investor, I should start thinking to leave you and go somewhere else. And if I'm a new investor, I should rather hold myself away. Hey, I think I should find some other company. So that's a good point. So if your financial health check coming from the balance sheet is promising, then it gives me a sort of relief to invest. I feel more secure. But if the financial health is not so good, that the gap between assets and liabilities is small, it means that you have a high chance of becoming insolvent. Well, I should stay away. If I still invest, then I am not a rational investor. And our first condition is that we have to behave rationally. Okay, so with this, I close this meeting now, and I would be sharing the recording with you, yeah? And now on, Tuan would be taking care of you, okay? So.
But how can I share it with the
Go to discussion forum.
I mean, how do I share my discussion with the actual? With
Do you have your computer?
the online student?
You